Good afternoon. This is Jeff Unalp from Unalp CPA Group, and S Corps are due just around the corner on March 15th, unless you get a 6-month extension. So in going through S Corp preparation, we've had various questions from clients that I thought it would be good to do a quick post on. So let me share my screen. And we're going to talk a little bit about S Corps and what S Corp basis is and shareholder loans. So I want to chat a little bit. And so on this post, we're going to go through basis. Why should you care about basis? Shareholder loans and distributions. Keep it even. So basis, think of basis as like a bank account. Okay, you have your initial investment or initial deposit, and then you put more deposits in and your bank account goes up. And then you take some money out and your bank account goes down. Here, basis is like a bank account. It shouldn't go below zero. If it goes below zero, some bad things happen. And that's what I want you to focus on here. So basis is your investment in your company. It is calculated by adding your investment plus any income made by the company, less distributions, shareholder distributions that they take, and less any losses that you incur. Now, I have a little graphic down here that shows, what increases, the arrow going up increases basis, and the arrow going down decreases basis. Now, in each tax return, your accountant, your CPA, should include a basis schedule, which will tell you what your basis is for each shareholder in the return. So take a look at that and know whether you have a lot of basis or a little basis. So every year you get that return, you should look at what your basis is, because that tells you how much you can take out in distributions. Now, if your basis, as I said, if your basis goes below zero, some bad things happen. If you take a distribution, you get taxed at a capital gains rate on that distribution in your personal return. So you will see, if you take out, let's say you're a 20% capital gains rate and you take out $10,000, you're going to get a $2,000 tax. And that is based on the distribution, because you have no basis. What the government thinks is that you're taking other people's money. You're taking lenders' money, or you're taking off a credit card, but you don't have that basis in there. Your losses get suspended. So if, let's say, you have zero basis and you get a $10,000 loss, the company has your portion of the company's loss is $10,000. You can't take that on your personal return. It's a suspended loss, and you will see that on your basis schedule. If you do take a distribution, you can always give a note to the company that you will repay that distribution. However, you have to pay interest on that note. So with that, let's go to shareholder loans. As I mentioned on the previous slide, sometimes in order to avoid paying tax on the distribution, shareholders will have to pay back, or will say that they're going to pay back the company. If it's over $10,000, best practice says the company and the shareholder should have a formal note with payment terms and interest in order for the IRS to recognize it as valid. And these payments should be made on time. Now, let's go to distributions. Shareholder distributions, for when you have and I'll give a for instance in a minute, but when you have two shareholders, when one shareholder wants to take a distribution, the other shareholder has to take a distribution in a similar amount. So you have to be careful. You have to look at the basis of each shareholder. You have to consult with your partners or other shareholders and determine if it's going to affect somebody negatively. So there is some planning that goes in this. You can't some of our clients just try to take distributions willy-nilly. You really can't do that. It needs to be planned, or else it's might have an effect, a negative effect on one of your shareholders, and that will develop a bad relationship. So for instance, let's say we have two shareholders, and one is a 25% owner and one is a 75% owner, and the 25% owner needs $25. Well, at that point, the 25% owner needs to go to the 75% shareholder and say, hey, I need to take $25. And the 75% shareholder, after they consult together, might say, yeah, that's fine. So if not, this could invalidate the S Corp election, and it could become a dividend if the company is forced to lose that S Corp election and go to a C Corp. Then those distributions become dividends and taxed. So it's the worst of all worlds if that happens. So again, S Corps, they're wonderful organizations. You just have to plan before you take a distribution. There has to be a little planning involved. And we get this all the time where people don't plan, and there are negative consequences because they don't plan. So definitely talk to your CPA and talk to your other shareholders to ensure that there's no issues in the future. This is Jeff Unalp from Unalp CPA. I hope you have a good tax season.